Well, friends, today we want to talk about trading time frames. Guys, there's a feature available in global financial markets. One of the many interesting possibilities provided by this platform is that we can easily set our own specific trading time frame. Let's take a moment to get to know the individual candlestick in detail so we can see exactly how it appears for us across many different time frames. When we carefully analyze a single candlestick, we can see that it consists of four main and essential parts. There's a high, a low, an open, and a close. Well, the open and close are obvious. When the price opens at a certain point, that is, it's the open, and closes at another point, that's the close. Between this open and close, it's possible that lower prices have been seen, called the low, or higher prices have been seen, called the high. Here it's written, high, low, close, open. The highest price in a given time period is the high, the lowest price in that period is the low, the closing price is the close, and the opening price is the open. Let's take a look at the candlestick. We generally have two types of candlesticks. Either our candlestick is bullish or it's bearish. What's the difference between them? When our candlestick is bullish, it means the open price is lower and the close price is higher, like this. Let's take a look. Together? All right, look guys, right here the opening price is located. So what I am going to do is mark it clearly with the standard abbreviation O for you. Just take a second to see where that level sits on the chart right now. The open price is lower, the close or ending price is higher. When it opens at one point and closes higher, it means we have a bullish candlestick. The lower shadow or wick forms the low, which is the lowest point the price has reached during that candlestick's time frame. And when the upper shadow or wick forms, it creates the high, meaning the highest point the price has reached. Now, what does a bearish candlestick look like? Let's move on to the bearish candlestick, the second type of candlestick we're talking about. It's a bearish candlestick. This means our opening price is higher and our closing price is lower. In other words, the price opened at a higher point and closed at a lower point. But the high and low are just like before. That is, the highest point the price reached during this candlestick's time frame is our high. The lowest point the price reaches during this candlestick's time frame is our low. So when the open is higher and the close is lower, we have a bearish candlestick. These are all the types of candlesticks you need to recognize. Now, before I tell you about the different types of candlesticks, let's talk about time frames. So now that we're familiar with candlesticks, we want to teach you about trading time frames. Look guys, I'm going to write down the trading time frames that we have in the international markets here for you. Take a look, I'm using a red pen. All right guys, let me explain these terms. M1 actually stands for a 1 minute time frame. M5 represents a 5-minute interval. Then we have M15, which means 15 minutes of time. And finally, M30 refers to a full 30-minute period for your charts. Then we move on to the H1 time frame, which represents the 1-hour chart. Next, the H4 setting corresponds to the 4-hour interval, while the D1 indicator signifies the daily trading period. After that, the W label stands for the weekly overview, and finally, the M label represents the comprehensive monthly data view. All right, let's see what the difference is between these. When we look at a candlestick in the M1 time frame, that means the distance from open to close. For example, if it's a bullish candlestick, its open is at the bottom, close is at the top. This is the low, and this is the high. So what happens from the time the price opens to the time it closes only takes 1 minute. That is in the 1 minute time frame. When we look at our chart, each candlestick we see has only lasted 1 minute. All right, let me draw a few candlesticks here. For example, there is a specific candlestick here. Then we see another distinct one right over here. And yet another one further along here, right? And let's not forget one more here. Let's say this first one is bearish. This second one successfully resulted in a profitable trade. No, this third one also made a profit. And this final candlestick also followed the trend and moved downwards. Isn't that right? Looking closely here, we can see that we have a total of 5 candlesticks, each lasting 1 minute. Right? In our time frame, we see 5 candlesticks. That means each of these candlesticks took 1 minute to form, and we have 5 1-minute candlesticks. Guys, there's a rule called candlestick combination. If we take the open of the first candlestick, let me mark it with this color. If we take the open of the first candlestick, and this was a bearish candlestick, for the last one it means its open is high and its close is low. If we also take the close of the last candlestick, that is one close and one open, and in between we consider the body of the candlestick. If we take the lowest point seen in these 5 candlesticks as a shadow low, and the highest point seen in these 5 candlesticks as well as a high point, guys, now we've created a 5-minute candlestick. Look, this is a single M5 candlestick, meaning each candlestick in the 1-minute time frame took 1 minute to form. When we move to the 5-minute time frame, we see these 5 as a single candlestick. Right? So this is exactly how different time frames build on top of each other. Let's go ahead and bring up another blank page right now so we can carefully track this specific topic here. So we have clearly understood that in a 1-minute window, if you happen to have 5 individual candlesticks, these are also 5 1-minute candlesticks. It comes together. Initially, it forms a single 5-minute candlestick, which is then followed by a sequence of 6 additional 5-minute candlesticks. Now, you might wonder, what exactly does the price action do next in this scenario? Well, it effectively creates one 15-minute candlestick for us to analyze, right? And following that same logical progression, we can see that 2 of these 15-minute candlesticks combine to make one 30-minute candlestick for us. Furthermore, this process continues as 2 of those 30-minute candlesticks eventually form a higher time frame candle. Now, no matter what form they take, it creates one for us. It creates a single H1 candlestick, and as we know, 4 of these H1 candlesticks come together to make one H4 candlestick for us. Now guys, if we look at the daily cycle, 6 of these H4 candlesticks are needed. 1, 2, 3, 4, 5, and finally 6 to complete the full period. For example, 6 H4 candlesticks make one daily candlestick for us, and 5 daily candlesticks, well, will make one weekly candlestick. Why do 5 daily candlesticks make one weekly candlestick? Because on Saturdays and Sundays, the global market is closed, and it takes Monday, Tuesday, Wednesday, Thursday, and Friday, 5 days of the week, for a week to be completed. And 4 weekly candlesticks make for us one. It creates a monthly candlestick, okay? So we understood that the market starts from minute by minute and goes all the way up to the monthly candlestick. It's really beautiful because this order and structure in the market is like this. So if we want to, let's review it ourselves. In this way, each candlestick in the 1-minute time frame takes 1 minute to form from open to close. If we combine 5 of them together, you'll see that it takes 5 minutes to form a 5-minute candlestick. If we combine 15 of them together, it becomes a 15-minute candlestick, or if you combine 3 5-minute candlesticks, you get a 15-minute one, and so on up to the monthly time frame. All right, now let's go back. Back to the topic of candlesticks. In the discussion about candlesticks, we reached the point of what components a candlestick is made of. So what exactly is the specific distance between the opening price and the closing price for us? Well, that vertical distance from the open to the close is what we call the real body of the candlestick. The edges that form the lows are the shadows of our candlestick. Well, these sizes and these shadows have certain implications. They tell us that certain things are happening, which we will discuss here. A large size in a candlestick indicates buyer strength. What does that mean? It means when there is a big distance from open to close, forming a large body. It means the buyers were so strong that they pushed the difference between open and close way up, or it could be the seller's strength. When we have a bearish candlestick and the open to close has dropped this much, it means the sellers were so strong from the point where they started selling. In that time frame up to the point where the selling ended, it created a big candlestick for us in that same time frame. Candlesticks with large bodies, therefore, indicate strong power from either the buyers or the sellers, regardless of whether the candlestick is bullish or bearish. That is, the larger the body of our candlestick, the more it indicates the strength of the buyers or sellers. Now, to determine whether it's the buyers or sellers, you can also refer to the color of the candlestick. So even just by looking at the market visually, we can see that the candlesticks we've set as white in the template, meaning the bullish ones, show that the buyers are gaining more strength. If we've set black for bearish candles and we see that there are more black candles, it means the sellers are gaining more strength. Now let's move on to the shadows, which are the wicks you see on the candlestick. They form our highs and lows. The upper and lower shadows are meant to convey specific meanings to us. How so? A long shadow on a candle indicates a sudden increase in demand or supply. What does that mean? It means when you have a full-bodied candle, for example, a large white body in a 5-minute time frame. This candle forms mostly in the first 2 minutes going up, and then in the next 2 or 3 minutes it completes entirely. It comes back and closes much lower, and because the price action has traveled this distance, it leaves a large upper shadow behind. In fact, there was demand behind this price. Buyers entered and pushed the price up to a pretty high level. But then the selling pressure became so strong that the sellers managed to take control and pull it back down. Now let me explain. Let's look at this as an example. Look guys, for instance, imagine you have this situation. On the 1-minute time frame, you see a bullish candle. In the second minute, you see another bullish candle. In the third minute, you see yet another bullish candle. With a very small body appearing in the 4th minute, there is a large bearish candle. And then in the 5th minute, we see an even larger bearish candle, right? We previously said that by combining these 5 1-minute candles together, what exactly does that do? It creates a single 5-minute candle for us. How? In such a way that the open of the first bullish candle is here. So the open is at the bottom, the close is at the top. We take the open of the first candle. That becomes the open of the candle. We take the close of the last candle, and that becomes the close of the candle. The distance between them is the body. The highest point the price reaches in these 5 minutes becomes the high, and the lowest point the price reaches becomes the low. That's the lower shadow. All right, now look guys, here a bearish candle has formed where the open is at the top and the close is at the bottom. So this candle is bearish. But it has left us with a large shadow up there. Look, here is the high, here is the low. Basically for 2 minutes it went up, paused for a minute, and then dropped a lot in 2 minutes. What is this showing us? In the first 2 minutes, the buyers were very enthusiastic and were pushing the price up. Here, with this candle that we see, the strength of supply and demand has become equal. The buyers are no longer stronger, and then we see what happens next. How much stronger did the sellers become that after 5 minutes we had a candle with a large upper shadow? This shadow indicates a demand that has disappeared. That is, a demand was created and the buyers eliminated that demand, resulting in such a large shadow for us. Now let's go back to our discussion about shadows, which we talked about earlier. Some candles have different shapes, and based on their appearance we give them certain names, like what? Doji candle, hammer candle, or the same hammer, morning star, evening star, shooting star, 3 black crows, and 3 white soldiers. The first one we want to get more familiar with together is the doji candle. The concept of doji refers to candlestick charts where the opening and closing prices are the same. A doji has a thin body and is usually shown as a thin, narrow line. It happens when hesitation between buyers and sellers causes the open and close to get so close that the body becomes so small, and that's why we use this term for a candle whose body is very small. We call it doji. There are different types of doji. Some have long upper and lower shadows. It's the confrontation between the open and close. When they're exactly on the same line, we call these long-legged doji. There are some doji that have a long upper shadow. We call these gravestone doji, meaning it has an upper shadow. Then when the open and close are equal, music, there are some doji known as dragonfly doji. Let's continue. Let's take a look together. That dragonfly doji has a long lower shadow. Alright, for the long-legged doji, you need to have a low starting price. Kids, what does that mean? As we said, a candlestick is made up of 4 parts. Here, what are we seeing? We're seeing the low of the candle and the high of the candle. Both the open and close are at the same point. For us, it doesn't have a body or a companion. It's simply showing a doji candlestick. In this time frame, the result has been that the strength of buyers and sellers was equal. Let's look at the next case, the gravestone doji. As you can see from its shape, it doesn't have a lower shadow. What does that mean? It means there is no low for us here. It hasn't formed a low. It has a high. and it has an open and close that are equal. Well, here this doji indicates that the opening and closing prices are the same, and there has been a significant demand, which is the opposite of the gravestone doji in the dragonfly doji. We have a low here, but there is no high. How does that look? It looks like this. The open and close are also equal, which is why we call it a doji. That means there has been a supply that has been absorbed. In other words, the market dropped so much that it reached this price, but everything reversed from here. After opening, it went down, hit this low, then completely reversed and closed again at the open point. Now, in any definition you want to use, it creates a gravestone doji for us. Let's move on to the next pattern together. In the next pattern, we want to talk about the hammer candlestick and all related candlesticks. Guys, the hammer pattern usually appears at the end of a downtrend, and this pattern has three very important characteristics. The body of the candlestick is at the top. You've seen a hammer, the top part is like the metal head, and when we think of a hammer, the handle is at the bottom and the metal edge is at the top. This is just like that. It's as if it has a handle and a metal head on top. The shadow is below and the body is on top. Basically, what happens with the hammer pattern is that the shadow is twice as large as the body. The second characteristic of the hammer is that it has a long shadow that is twice the size of its body. What's the third characteristic? It doesn't have an upper shadow, or if it does, it's a very small one, just a tiny upper shadow. Okay, but if we want to consider the color of the bodies as a separate characteristic, we can count that as well. When a hammer appears at the end of a downtrend, we expect something to happen. For example, look here. There's a downtrend and we've reached a hammer. Well, when the body of our hammer is white, it means the open is at the bottom and the close is at the top. Well, it's much stronger for us to have the start of a bullish trend. Compared to a hammer with a black body, which we know turns black or bearish when the open is higher and the close is lower. Of course, that one is also valid, but the validity of the white body is much higher. Okay, the next type of pattern we want to talk about is this one. There's a very famous pattern called the shooting star, or the same as the falling star. Just take the hammer and flip it upside down. Here we see that the body has come down and then gone up, right? We expected, just like with the hammer at the end of a downtrend, that this coming down would indicate supply or weakness, meaning that strong demand has entered, and the analysis is that an upward trend is about to form. With the shooting star, it's exactly the opposite of the hammer. Our expectation is that this appears at the end of an uptrend. Demand has disappeared, and here the open is high. The close is low, signaling the start of a downtrend. We actually call these reversal candles, meaning a reversal or a turnaround is about to happen in the market. These act as indicators or triggers that alert us to a possible change. A reversal is about to happen in the market. This event occurs on the chart with all the different types of these candles. We will examine them together to see where in the trends these patterns form for us, where they appear, become significant, or which of these shapes we should pay more attention to. Focus on.